and I guess we can find more from her speech. 那下面呢，我们还有一个远程加入进来的一个主题分享，来自于 Solana Foundation 的 President Lily Liu。那他会呢介绍一个全新的金融概念 PayFi， 然后从他的演讲当中，我们将更好的理解到底什么是 PayFi， 它的创新理念、核心技术和未来的发展方向。Let's welcome Lily. Lily.
Hi.
Hi.
Thank you for having me.
Applause.
Thank you so much for having me. All right. I think you guys have my slides. Would you be able to pull those up?
Hi, Lily. We are pulling out the PPT, and it may take a minute or so.
Okay. Cool.
Hi, where are you now?
I am in Europe. I live in Europe. I was actually just in Hong Kong last Friday.
Oh, we missed you.
So a couple of days ago. Unfortunately, I couldn't stay another couple of days. But it's been really great to get to know the Foresight team over the last probably year or so. And so I wouldn't miss being a part of the Foresight Summit, however I would be able to. So thank you for having me.
Oh, our pleasure. It's our honor to have you here. And I think here we have a lot of Solana fans, so they can't wait to hear the new concept, PayFi.
Sure. Yeah, it's been great to be a part of Solana's reintroduction into the APAC region. So our team got started about a little over a year ago based out of Hong Kong. And let's see, that was I think May of 2023. And if you remember, there was a period of time after November of 2022 when a lot of people had a lot of questions, particularly in APAC, right, about what the future of Solana was. And so, for me, as someone that discovered Bitcoin 10 years ago when I was living in Shanghai, to me, sort of the story of crypto has been for me, my personal experience has been centered on crypto in the APAC region. It's been very near and dear to my heart. And so having the opportunity to help Solana kind of be reintroduced into APAC is really exciting for me. So, okay.
The technician just asked me to ask you a question because it's a little bit difficult on our side to play the slide. So do you mind to share your slide as well? We just get the PayFi slide, but we don't know how to synchronize with your presentation. So it might be better.
Okay. So should I share my screen then?
Yes. Let's see.
Okay. All right. Let me work on that.
I think we can still see you when we are seeing your shared screen.
Okay. Then let me do that. Are you able to see that?
Yes. Perfectly.
Okay, great.
Yeah.
Let me do slideshow.
Lovely.
How
Carry
does it look?
on. Yeah,
Yeah?
look
Does that
great.
look good?
Yeah.
Okay.
Yeah.
Perfect.
Go ahead.
And there we go. All right. So looks great. All right. Should we get started?
Yes.
Cool. All
Let's
right.
do it.
Thank you for your help. All right. So let's see. There's a lot happening in the Solana ecosystem today. I would say that there's probably only two really scale ecosystems that can be considered general purpose smart contract platforms. And I think, clearly Ethereum is one of them. And I think the only other one that's come after Ethereum that kind of started in that 2017, 2018 era, if you remember that, there was this whole thing around Ethereum killers. I've never liked that term, right? As an aside, I consider us all to be kind of compatriots in the adoption of self-custody. But after Bitcoin, there's basically been two smart contract platforms that have really been able to scale, right? And when I say scale, it's not just about the underlying technical scaling, although of course that's very important and precondition for everything else. But there's, the other aspects of scaling an ecosystem, which is around bringing capital and then also talent on chain. And when you look at which ecosystems have been able to do that successfully, it's in my mind really only a small handful. And so today there's so many things that are happening in Solana. Depending on who you talk to, there's DePIN, meme coins or meme coins, right? Have obviously been very popular as well. And then there's also a lot of traditional finances happening, stable coins, payments, right? So many different things, too much to really talk about. The one thing I wanted to talk about in terms of kind of future vision of where we're going to be going from here, amongst the many things, the one I wanted to talk about is something we call PayFi. Okay, so PayFi. To me, what is the motivation for this? It really starts with the original vision of Bitcoin and what Solana can do today to help implement that original vision of Bitcoin. So what is the original vision for blockchain? Well, it started off with Bitcoin in 2008, and it's really at the top of the Bitcoin white paper, a peer-to-peer electronic cash system. And that's in 2008 what really started all of this here. And what is that really about? Well, Bitcoin and blockchain proposed quite a number of things, but what it really started with is this idea that you could have self-custody. And with self-custody, so here's a screenshot of the original Bitcoin Genesis wallet. What self-custody means is that you have digital property rights. And in an increasingly digital world, that's really important because there's so many things from your actual money to your data that are valuable, that need to have property rights around them. And being able to sort of have digitally enforceable, mathematically sort of enforced digital property rights are, in my mind, obviously very important, as now increasingly the vast majority of the things that we interact with actually do kind of live primarily online. Okay, so self-custody gives you mathematically enforceable digital property rights. And what becomes exciting about this in crypto, and this has been articulated for over a decade now, is the idea that once you add in smart contracts, then what you have is you have the ability to do programmable money, and you can build an open financial system. And so what Ethereum did for us, especially coming up into DeFi summer in 2020 was, with introduction of and the scaling of AMMs online, paired with lend borrow, it allowed us to create these financial markets largely based around trading that have scaled actually the many billions of dollars programmable money in an open financial system, meaning that if you have self-custody, you have digital property rights, and anyone with an internet connection now effectively has financial access or a bank account, so to speak. The one issue with it is there is an inherent accessibility issue, not because you can't sort of log in with your wallet online, but because, going back to the scalability issue, there are times when congestion means prices go up to some extraordinary amount. So you'll see, there's been times when on a really exciting day, you have to pay $800 in order to complete a transaction. And whatever technical and whatever sort of trade-off trilemma types of conversations one can have about that, it is just unaffordable for the vast majority of people. It's unaffordable for retail, period, and unaffordable for many businesses as well. And so this is something that actually becomes a rate limiter on the growth of programmable money open financial system in its existing sort of scale instantiation today. Okay, so furthermore, why is any of this important? Well, the idea that where you have an internet connection, you can have a bank account, basically means that in an increasingly digital world, you can actually have economic sovereignty, which is pretty exciting, right? Because that's really something that actually most people in the world don't really have. You might think you do, but I think as we saw in 2008, as a friend put it, you just kind of realize no one owns anything actually. Okay, and then furthermore, this book, The Sovereign Individual, is written in the 1990s. I consider this to be required reading in crypto. And what's really powerful about it is even though it was written 30 years ago, it articulated many, many things about what the internet would enable that have been very visionary. And there's kind of this 20-page section in there where it speaks specifically about essentially what was like a blueprint for Bitcoin, economic sovereignty, and how economic sovereignty is an important component of self-sovereignty. So just screenshot one of the many sort of prescient passages in there, but it talks about how new technologies will allow the holders of wealth to bypass national monopolies that have issued and regulated money in the modern period. Talks about how the world's wealth will be transcended by mathematical algorithms that have no physical existence. Does that sound familiar? So to me, this is the original vision that Bitcoin laid out for us. In a very simple form, could call it peer-to-peer electronic cash system, right? But it really sort of by self-custody, once you pull on that string a little bit, becomes a very expansive and very profound sort of implication as to how self-custody enables self-sovereignty in an increasingly digital world. Okay, so that to me is the original vision of blockchain. And if you also go back into the annals of blockchain history now, Bitcoin, originally, there was a lot of discourse around what exactly is this technology going to be. And today, we've kind of settled on store value, digital gold, and we're sort of all coalesced around that. But back then, it was an ongoing discourse, actually. Is it a store of value? Is Bitcoin going to be a medium of exchange? Is it going to be a technology platform? And there, if you go back and read some of the earlier blog posts, there were a number of people that were really excited about technology platform for programmable money, right? And Bitcoin becoming a competitor to the Visa network. And what happened in the years leading up to the block size debate was this kind of the industry coalescing actually with quite some disagreement, I would say at the time, that Bitcoin's value would be, it being a bearer instrument, digital gold, and actually its value would be that it never changed. And so that is fine. It's great. Bitcoin's doing great. But what about these two parts of sort of the blockchain thesis, right? What about the medium exchange? What about blockchains as a technology platform? And in my mind, all of the technologies that have come after Bitcoin are really addressing this original part of the vision, right? This is not mutually exclusive. It is complementary. And so where I see Solana's role is really being that smart contract platform that can help us build decentralized applications, including financial applications, to make this original vision of blockchain real and make it accessible and bring that to and really start to realize this sort of where you have a bank account, where you have an internet connection, you have a bank account vision. Okay, so on the financial use case, right? So these are some of the earlier projects that we've had in crypto. And the narrative for this, when you talk about medium exchange and payments, the narrative has always been around blockchain payments are better because they're faster, cheaper, and they're constant, right? Basically, if the internet is on, you can use it, you can transmit value. That is a powerful narrative, but in my mind, it's not good enough. Why? Because I think that the way this is typically framed, which is interchange is 1.5% when you swipe a credit card, or if you're moving money through, let's call it a Western Union or a MoneyGram, it costs you about 6%, right? And comparatively, as the narrative goes, if you use blockchain, then it's faster and it's a fraction of the cost, much less than 1.5% or 6%. But to me, this narrative is not good enough. I don't think the value proposition of just faster, cheaper, and constant, while good, I don't think it's good enough to actually drive global adoption of, for example, stablecoin-based payments, which is now sort of front and center in our industry. And why is that? Because I think taking a step back, new technologies are always about enabling new markets. So if you look at the internet, kind of Web 1 and Web 2 internet, in the late 90s, when we were all chatting with one another on AOL, probably the Western world, or QQ in the Eastern world, a number of folks thought that the existing media companies like Time Warner, in the U.S. example, were going to dominate the internet, right? We thought what it was going to be. They had all the content, so they were just going to take that content online, and naturally, they would probably dominate this new kind of technology and its implementation, its usage in the world. Of course, that's not what happened, right? Of course, all of these content publishers, they did digitize the newspaper, but that wasn't anywhere close to the killer application for adoption because it was too skeuomorphic, right? It was too much sort of just digitizing the newspaper, when what really was exciting about the internet was its ability to reveal, organize, and monetize long-tail markets. So in the very beginning, we had something called Blogger, right, that got bought by Google. But what Blogger enabled content creators or writers to write long-form content to blog, and anyone could discover that content. And what it did is it revealed an entirely new sort of sector of society, I guess, that could be content producers, and it helped organize the audience and eventually helped monetize long-tail financial markets around demand for and the production of that content. That was originally in long-form content. Obviously, sort of the distributed, the decentralized content creation market, I guess is one way you could put it, is much, much, much more diverse than that today, with video and tweets, short form, long form, vertical, horizontal, so many different forms of content today. But fundamentally, in my mind, that's what's been going on here. New technology enabled content creation to be diversified and really decentralized massively from corporate media, and revealed, organized, monetized a long tail market. And I would argue the same thing happened with like Uber and Didi starting in 2009, 2010, right? That's the original logo for Uber. And there's always been a market. There's always been supply demand, I should say, rather. There's always been supply and demand for riders and drivers at any moment in time. The issue is that you could never reveal, organize, or monetize that market until you had a GPS-enabled smartphone. And that created what is now these, tens of billions of dollars of companies, also providing a lot of value to the two sides of that marketplace with something like an Uber. And I think it's interesting to point out, with these new technologies, the supply and demand is never actually new supply and demand. It's just latent supply and demand, because human behavior is human behavior. And it's just, it's latent and might be non-obvious, but none of these things are actually sort of new needs and wants, right? Okay, so in my view, these new technologies enabled not just sort of skeuomorphic digitizing something that already exists, or blockchainifying something that already exists, or iPhoning something that already exists, but it's really about enabling 10x use cases. And so why hasn't this existed in crypto yet, right? We have this 15-year-old white paper talking about a peer-to-peer electronic cash system and programmable money, open financial system. And we're doing okay right now. I would say we've got certainly 8 figures of fairly constant users of this technology around the world. But why aren't we at 1 billion as an industry? Why not 3 or 4 billion? Why is it not the case that everyone that has an internet connection basically also has a crypto wallet with some degree of usage? Okay, in my opinion, it's because you have to hit 3 conditions, not a trilemma, but you've got to fulfill 3 conditions to even start to be able to offer this as a viable value proposition to an average user. And those 3, in my mind, are performance, capital liquidity, and talent liquidity. All right, so let's talk about performance. Performance, typically people will frame performance in terms of time to finality and or TPS, right, transactions per second. So on that very popular framing of performance, Solana is 400 milliseconds to finality and several thousand TPS on any given day. Another way of thinking about performance is another very common thing that people do is minting NFTs. What we did last year is we introduced stake compression that brought the cost of minting NFTs down so dramatically. It's now $100, maybe a couple $100 to mint 1 million NFTs. Comparatively, if you look at other infrastructure in the ecosystem, the cost of doing so could be in the hundreds of thousands, even in the millions of dollars in order to mint an NFT. The one thing to point out here is it's not just about the first order cost. Of course, you'd rather spend a couple $100 than a couple $1 million. But the second and third order implications of performance is that it opens up the design space for new products. I think one comparison that you can make is to the original internet when we were all on 56K modems, and then there was high bandwidth, initially Ethernet and now fiber, that came along later, kind of new infrastructure that made not only made it faster and cheaper to do what you want to do on the internet, but it also opened up entirely new product design spaces. For example, something like streaming video. Netflix as a company existed in the 90s, and they were basically mailing DVDs around. It's a huge business for them. And Netflix is now streaming video. Now, obviously, it's the same company, and you could say they're still in the entertainment industry, but the business model and the product and the user experience is so dramatically different because the world has moved from 56K modems to high bandwidth internet. Okay, so the second condition in my mind is capital liquidity. So Solana is top 3 stablecoin transaction volume, at times number 1. And what's important to point out here as well is it's liquidity and capital that can actually be used as a medium of exchange. And that's why we're pointing out stablecoins. As much as we love Bitcoin, as much as we love these various crypto native assets, no one denominates their everyday lives. No one denominates current commerce in Bitcoin or Ethereum or Solana or pick your token, right? People still denominate their everyday lives and commerce in typically fiat currency. And as an industry, you've got to be pragmatic and meet the world where it is, which means having scale, stablecoin, and stablecoin related asset issuance is really key because that's the basis for commerce today. The third condition is talent liquidity. And what I mean by that is really independent developers. This is an extremely hard thing to do, to build a developer ecosystem. And essentially, you're asking people to sort of abandon their existing professional lives, take a risk on this new thing called Web3, which has a variable reputation over time, depending on where you're coming from and where you're going to. And so it's a pretty hard thing to do around entirely sort of new stack as well. So Solana today is the number 2 developer ecosystem. And so just to recap, in my mind, you've got to have 3 things present at scale at the same time in order to really realize this original vision of blockchain: performance, capital liquidity, and talent liquidity. Said another way, a chain which is fast and cheap, has liquidity and money that people actually use, and independent developers. And importantly, I know that in this industry, we've had a lot of conversation over many years about how everything is a trilemma, so you've always got to pick your 2 out of 3. I don't think that we need to accept that or should accept that or can accept that, because in order for this technology to really scale, you've got to have all 3 of those things in the same place, and you cannot see it as a trilemma. Okay, so talking about PayFi. PayFi isn't it just DeFi? In my mind, it's not DeFi, because DeFi, the way we use that term today, typically refers to a trade. And what that means is you're sending in one token and you're getting another token back. That's a trade. Payments and commerce are about where you send, let's say, a token in and you're getting a good or service back. And so payments are around settlements, not trades. And when you're sending in a token and getting a good or service back, there is a production value chain associated with that good or service, right? That's commerce, it's not trading. And with that production kind of value chain, there's inherently a time value of money involved in that. So to me, PayFi is around building new financial primitives based around settlements and payments rather than trades. And this is something that does not exist at scale in crypto. But to me, I think it's the much larger, this is the much larger market. This is much more useful market. Because when you think about it, how much of the economy is commerce? Well, it's kind of the definition of an economy. Okay, so I'm going to walk through 3 different examples of how this might be relevant in a retail, a digitally native producer, and then also a corporate setting. The first is in a retail setting. We've all heard of buy now, pay later. That's Affirm, that's Klarna, right? At the point of checkout, you can choose to pay whatever the value of that transaction is over time. And then, of course, there's interest involved in that, so on and so forth. Okay, so that's how the Web2 kind of fintech world does things. It's a huge business. Klarna and Affirm have been very successful companies. Well, in crypto, you could potentially architect something that's called buy now, pay never. Sounds better than buy now, pay later. And the way that would work is in crypto, we always like to talk about paying for coffee. So let's say you pay $5 for coffee, and there's some intermediary that pays that $5 on your behalf. And instead, what you do is you take, could be $50, $500, or $5,000. You put that into a lend borrow, for example, Camino on Solana, and the interest from that would pay off your $5 coffee purchase over time. If you put in more, then you'd pay off sooner, and you would end up paying less. But let's say you put in $50 and you end up paying $5.50 because you essentially finance that coffee off of the interest on your Camino deposit. So this is the type of thing that you could do automatically, programmatically on chain. And it's the type of thing that you could never do in the existing financial world for a number of different reasons. One is because you don't have truly sort of natively programmable money. The other is you don't have these very liquid lend borrow markets where you can lend and borrow such small amounts of money. And you also don't have an interest-bearing sort of market around that can then programmatically, once you put all those things together, go pay off essentially what's a micro purchase over time and do that autonomously. So that's one retail example. Another example is creator monetization. So we're talking about the advent of the creator economy that really started 30 years ago, long form blog posts and content creation. Much more diverse industry today. And if you just look at one of those types of content, for example, video views. On YouTube, 1 million view video is worth probably around $10,000. It's a big range, but let's call it $10,000. Now, the creator would be getting that revenue over time, over a span of many months as the views come in. And that creators are typically individual, basically sole proprietors, right? They're not running a very large business typically. And that creator many times would love to get a $9,000 advance in order to finance their next production. And so there could be a market around folks that are willing to lend to that creator, lend the $9,000 today, and then recover the $10,000 over time. This is an example of a market that where the supply and demand very much exists today. It's a large market. There are traditionally structured funds that actually do finance this market, but can only do so for very, very large creators and in ways that are ultimately mediated by thick stacks of paper contracts, right? So we know the supply and demand exist here, but this is very much a long tail market that is digitally native and cannot be served by the existing kind of financial system and the existing legal system. A third example, this is a massive market today as well, right? Invoice financing, AR financing. So if if I'm a business and I'm owed $100,000 in typical net 30 payment days, I might be willing to take $95,000 today, and someone would lend me those $95,000 and then receive the $100,000 in 30 days. Huge market, huge market really around the world. But then the long tail here of supply and demand that cannot be financed today is smaller enterprises Typically, if you are going to qualify for invoice financing, you've got to be a relatively large business, even like a large SME, a big SME, even if that's a little bit of a contradiction in terms. And you've also got to have, 3 years of audited financial statements and also good relationship with a certain type of bank that will be providing this financing. Once you kind of put various businesses through all those various gates, it's actually a minority of businesses that will have access to this type of financing. Furthermore, it's not possible to finance just a single invoice, right? So you've got to be onboarded as an entire company and before you could finance even a single invoice. And if you're not onboarded with all of those kind of requirements, then you don't have access to this type of financing. And this underpins a huge amount of just commerce around the world, right? So existing supply and demand, a long tail market that is not currently being served and could be if you have fast, cheap, constant programmable payments. All right, so getting a little bit more into how this could actually be architected in crypto. So take payment processing. The way payment processing works today, at its simplest, is you have a payment processor that kind of vertically integrates KYC, money movement around the world, and then address management, pay in and pay out for the customer, right? So if you look at the right side of this, it's kind of vertically integrates a KYC, liquidity pool, and the customer. One way you could potentially re-architect this using crypto is to disaggregate these 3 different parts of what a payment processor does. So the payment processor still does the KYC, right? But then what the payment processor currently does today is they'll take the funds, and you as the person that's paying in don't actually know whether they are managing those funds in the appropriate way, right? There have certainly been examples where folks bring in the funds and they divert those funds to other purposes and people find out too late. That's called fraud. So KYC, the liquidity pool, if it's on chain, then there's, to an extent, open monitoring of where those funds are going. And then on the customer side, or the receiver side, let's call it, the pay and payout address management, well, that's easy to do programmatically using blockchain, right? So you can imagine with the tools that we already have today, which is using stable coins and then the ability to create liquidity pools online, could be applied to payment processing and really moving money around the world. Okay, another example, kind of extending that concept of a KYC provider could also be evaluating credit, right? So the first example, sort of the V0 example, is payment processing use case. And then extension of that would be to take payment processing and then take that liquidity pool and introduce additional liquidity pools that would really be around private credit pools. And this is where borrower would be not just KYC, but evaluated for their creditworthiness of however they want to be using the funds. But then you could adapt certain aspects of the liquidity pool, and then instead of the receiver, call that a lender. And you could take similar types of constructs and adapt payment processing pool really to broader applications of private credit. And if you look at the sort of the entirety of, commerce, time value of money, financing production of goods and services around the world, well, this is the vast majority of the economy. When you look at supply chain finance, payday loans, credit cards, corporate credit, interbank repo markets, insurance markets, there's an aspect of time value of money to all of these existing financial products. And these are existing markets, once again, supply and demand. They just have very large long tails that are not currently served because they are global, and moving money around the world is slow and expensive. It takes days at the very least. And or the potential participants in these markets are not able to access them because they're of too small scale. So that for us is what we've been talking about as PayFi. To me, this is part of the original value, or the original vision of Bitcoin and blockchain. And when Bitcoin really focused on being digital gold, while being $1 trillion asset, there's this whole other side of blockchain and its original vision around programmable money, right? Around medium exchange and how you sort of make finance open to everyone on the internet. And that's what we call PayFi. People are building PayFi within Solana. And my perspective is that because this can only happen if you don't have this kind of trilemma view of the world. And so when I look around, I think the only place this is going to be happening is on Solana. So it's only possible on Solana. Okay.
Thank you, Lily.
Thank you very much. You can